Well, greetings everyone. Kia ora ana tātou katoa, tēnā koutou katoa, welcome. I was going to be saying it was great to welcome a larger room, but we've got a full room, albeit appropriately distanced. Thank you for making the effort to be here and in person, and we are live streaming also. I just want to, of course, introduce the wise people I have with me. I have our Assistant Governor, Christian Hawkesby, our Chief Economist, Yung Ha, and our Deputy Governor, Jeff Baskand, here as well, so to help and answer questions as we go through. I will just cover off what our announcement from today, and from today the Monetary Policy Committee agreed to expand the large-scale asset purchase program up to $100 billion. The aim is to further lower interest rates in order to be able to meet our remit. The eligible assets remain the same in the program, and likewise we've kept the official cash rate at 0.25%, consistent with the forward guidance we provided back in March, which I have to say now feels like a long time ago. Reflecting a possible need for further monetary stimulus, the committee has also agreed that a package of additional monetary instruments must remain in active preparation. The deployment of such tools will depend on the outlook for inflation and employment, and the package would include such things as a negative official cash rate, supported funding for retail banks for on-lending. We would call this a funding for lending program, and that lending would be at near OCR levels, and the purchase of foreign assets also remains an option. Over recent months, New Zealand had contained the spread of the COVID-19 virus locally, and this did allow a relaxation of social restrictions and a recovery to more normal levels of economic activity domestically. The recent indicators highlighted that the faster return to these social norms and a higher proportion of employees able to work from home underpinned a quicker than what we projected in the May monetary policy statement return to output and employment levels. So a quicker than projected recovery than our May monetary policy statement. We also see that recent spending in some extent reflected a lot of pent-up demand built up during that lockdown period. However, the severe global economic disruption caused by the pandemic is persisting, and we believe any significant change in the global and domestic economic outlook remains very much dependent on the containment of the virus, which is a highly uncertain factor, as evidenced today by the return to the social restrictions in New Zealand. Such uncertainty is stifling household and business spending appetites, domestically and globally, particularly as highlighted through confidence surveys. Given the ongoing health uncertainty, there remains a downside risk to what we consider our baseline economic scenario, put it in our monetary policy statement today. International border restrictions, no surprise, are likely to continue to significantly curtail migration and tourism and lead to the activity outlook being very uneven across industries and regions in New Zealand. Commodity prices for New Zealand's exports have held up, but we note that that has come along with also an appreciation of the New Zealand dollar exchange rate, moderating somewhat the returns to New Zealand exporters. Ongoing support for domestic activity is being provided through significant government spending and business assistance and household income support. And we see that this support will be rising with increased government investment over the period ahead. However, there is a transition of policies in the near term, with the announced end of the wage subsidy likely to coincide with a decline in employment. So we are transitioning through lots of different fiscal policy support. Fiscal policy remains very much the front primary focus of response to the economic shock. Having said that, monetary policy will continue to provide an important economic support in the period ahead. Its effectiveness is evidenced by retail banks' lower funding costs and lending rates, and these lending rates are benefiting businesses and households. and it remains in the long-term interests of banks to fully pass on the benefits of these lower funding costs to their customers via lower lending rates. The Monetary Policy Committee will provide additional stimulus as necessary to meet its remit. Meitaki, thank you very much, and we are here to take questions.
In terms of the committee's decision to increase the size of the LSAT program, was that made after we found out about this second outbreak of COVID?
The decision was finalised today. The information hadn't really changed our decision though, so the information came through. We were right near the end, so the final decision today, as usual, keeping all optionality open, but we didn't change our preliminary position.
Praveen Mehta from Reuters. It's a follow-up from that question in the sense that how much did the events of the last 24 hours feature in the decision, and what's your view on if this lockdown or the restrictions are being extended?
Yeah, thank you. I mean, I totally understand the interest. Really, the information that we received last night, literally minutes, well, that I received minutes before everyone else, as a courtesy heads up, has not materially impacted our decision today. Why hasn't it materially impacted it? Because we have been operating for some time now under what we call baseline economic scenarios rather than precise predictions. And this scenario that we're operating under gives us enormous scope for additional support, and that's what we were doing. Also, we don't know anything more than what is publicly known with regard to the extent or whatever is happening with the current news.
Hamish Rutherford from the New Zealand Herald. How close is the system to being ready for things like negative interest rates?
We gave the banks a very clear steer that, by December we want to see real practical capability of doing it. Likewise, though, we've said that we've committed to our March forward guidance for the keeping the OCR at 0.25. But the banks have been making significant progress around readiness for that part. What we're also talking about, particularly in this document, is that it's not just a single instrument. So our challenge here for the Monetary Policy Committee is really about what makes a sensible package for Aotearoa New Zealand from the instruments available that achieve our remit whilst also managing and mitigating any of the risks involved, which is why we deliberately choose that word package of instruments, and we think that working with the industry, we can tailor something that best suits our needs.
Giles Bedford, Radio New Zealand. Would the increase in LSAP have been as big if you hadn't had the latest information overnight?
Yes.
Question submitted from media that can't attend you, Patrick.
Hi Adrian, this is from Kangan News. Could you provide an idea as to how much of the New Zealand government bond market you estimate you will own if you would purchase, say, $97 billion worth of bonds by June 22, and whether that remaining free float of bonds will be enough for other investors to appropriately judge pricing in government bonds and other bonds?
So I'll answer at the broad level, then I'm going to pass over to Christian, but without doubt we are making very deliberate steps to ensure that there is a significant proportion of government bonds that have been issued remaining available to holders other than the Reserve Bank. So one of our key goals is to ensure that that market is deep, liquid, efficient, whilst we can also achieve our purposes.
Yes, so on the specific question, if we were to hold $97 billion worth of government bonds by June 22, that would be around 60% of the government bonds outstanding. One of the changes that we made in the statement is that we've had the cap lifted on our maximum holdings of government bonds from 50% to 60% of the outstanding issuance, and that increase in that cap was made on a reassessment of the pool of bonds that could be left outstanding and still have a proper functioning market. That's something that we'll continue to monitor, and we're in close contact with the market and New Zealand debt management about that.
What caused you to change?
Thomas, Bobby from the...
Oh, sorry, Thomas Coughlin, Staff Dunk Fellow. What caused you to change your mind on that from the previous limit that you had?
There is no exact answer in terms of what is the right amount of bonds to leave on issue, and our initial assessment as a ballpark number was 50%. That was roughly in line with what we've seen internationally. But really what's more important than the proportion of the market is actually the amount that is needed. Another way to come at it, and what's been done in analysis before, is having an amount of government bonds that represent around 20% of GDP has been seen as a good free float for the market to continue functioning. There are fund managers, there are banks, there are other intermediaries that need these instruments to do what they do in markets.
Rebecca Howard from Business Desk. I was just curious about, I know obviously you don't know what's going to happen any more than anyone else does, but how concerned are you that these new restrictions could be extended for longer, or maybe we could see them again in, November, January, because your baseline scenario doesn't seem to build in the possibility, because it specifically mentioned that New Zealand would be at lockdown alert level 1 from June 2020 or lower.
I think I'll say a couple of things very quickly, and you're correct. We don't have any unique insight into the behaviour of this virus, but what we're talking about is sticking to baseline scenarios, and then thinking about the risks to the upside, the risks to the downsides, and how we navigate monetary policy through that type of space. We've said here as a baseline, and we've also said with that baseline, we still see the skew of the risks to the downside. Why do we see that? Because the key risks are a function of health, and health is the most uncertain variable here. So we can talk about upside risks, but the skew is still to the downside. The way in which to then think about scenarios ahead, it becomes an almost infinite game of, and there are different ways of doing this. And so we made basic assumptions that people can then use to test as things unfold against it. Well, how might a different outcome around, say, the health, the alert levels change at all in this period? The way in which, I'll say just from a personal note, as one member of the MPC, the way I would much rather prefer to think about this always is really just the anticipation of continuing rolling outbreaks around something that is continually contained in some manner over this period. So you can either express that as a big event once or many smaller events. This is the types of uncertainty. The optionality and the work we're doing here provides us a great ability to position for both downside risks, but also retain the ability for upside risk responses.
Did the committee give any consideration to changing the way that LSAP is done so that the Reserve Bank buys the bonds directly from Treasury, for example? Was consideration given to these instruments?
We have, and we've remained with our current policy, which is to be purchasing from the secondary market, in large part because it's working very effectively, and for all of the other market functioning reasons that Christian was just mentioning. Anything to add, Christian?
Yeah, I think it also makes that operational independence more clear, that New Zealand debt management issue debt, and they're acting as the funding agent for the government, and that drives their motivations. We are driven by monetary policy and the decisions of the MPC, and so we undertake our actions separately for that reason.
The record of meeting... Sorry, Matthew Brocker from Bloomberg News. The record of meeting mentioned front-loading bond purchases, and I see that you've actually put out next week's schedule today with an increase. Can we expect you to continue to increase the volume of your bond purchases in coming weeks?
Do you
Yeah, so we'll put that schedule out today. We normally put that out on a Friday. We put that out today to give transparency along with the decision. We wanted to make also clear that front loading of purchases was something that was endorsed by the MPC, because ultimately it's about delivering on the MPC's objectives, which is to keep yields low and the yield curve flat. And we'll retain the flexibility we have around deciding those weekly schedules pending market conditions.
I think the easiest way to think about it, Matthew, is a rule with discretion. So there is a certain amount of, well, there's certainty we want to provide the market of how much per week, but at times there will be opportunities to have discretion around altering that. There will be short-term discretions, which might be market functionality, which would be in the hands of bank staff who are there day to day, and they would be informing on a no-surprise basis, but operating around market stability. But there may also be opportunities where we want to step up or step down as a means of providing, you know, an impact on the level of interest rates and exchange rate.
That's what I wanted to ask. Are you actually actively trying to get bond yields lower than where they currently are?
Yes, I mean, the idea of expanding is to keep interest rates low and preferably lower than where they were prior to, and we're very explicit about that. We have to continuously remind people the end to the means is low and stable inflation and maximum sustainable employment, the path through which is low interest rates and a low exchange rate, and we're doing these purchases to achieve that. And if we don't achieve that, we will be doing more and or different things.
One more question, if I may. The headline number is quite big, 100 billion, but you've extended the time horizon by more than a year. So are you actually adding stimulus with your bond purchase program?
Yes. So do you want to talk about the quantity and the pace, or?
Yeah, I think some increase in the scale of our LSAT program was anticipated by markets, if not straight away over coming months. So I think some of what we've done has been priced into markets, but not completely. So we are expecting yields to fall lower from our actions. We think that $100 billion program gives us a lot of ammunition to drive down yields, and the 2-year time period also is a strong signal that we're going to be in this market for a long time. It's not going to be a fleeting influence.
One final one then. The unrestrained OCR track, if I'm looking at it correctly, doesn't actually go any lower than what it previously did. So can you perhaps just explain that?
Yeah, and that's, and I'll pass on to Jung to explain that, but in a sense it's a balance between a better than anticipated starting point and a continued soggy external outlook. And, you know, on balance, the framework, as best as the model, an unconstrained run of the model comes, it says there or thereabouts offsets each other. So, Jung?
Yeah, I mean, in a technical sense, we've got a slightly better starting point for GDP second quarter of this year, but we've extended our assumption about how long the borders are closed for from, you know, early next year to 2022. So the unders and overs, so the unconstrained OCR path looks broadly the same as it did back in May.
And I think an important point to take on board as well is that that path remains broadly the same despite the easing that we've done to date, i.e. there's a lot of work still ahead of the Reserve Bank if you took that forward path literally. You know, we have to do a lot of work to get the conditions we think are consistent with achieving our mandate.
You say it's in the best interest of banks to fully pass on the benefits of lower funding costs to their customers. Do you think they are?
We've seen some good moves on the interest rate side, so I'd say it's broadly one for one to date. You know, there's been timing issues, etc., around the lower funding costs through to the lower retail interest rates. So that has been, you know, that has been the case. We can quibble about how quickly or how slowly, etc. So that pass through has been good, and that gives us the confidence that the channel for monetary policy is working. That's not to say we aren't still watching incredibly closely around risk appetite of banks, you know, around credit lending criteria and willingness to take on new customers, and that's going to be an ongoing story as we see ahead. The banks have a lot of tough work ahead of them.
Bernard Hickey from Newsroom. Governor, the opposition finance spokesman has said he wants to see net debt down to 30% within a decade, and the Prime Minister says the fiscal situation is tight and seems to indicate that the current debt track is she wouldn't go any higher than that. Are you concerned at all that there might not be enough bonds to buy, that the government might not have loose enough fiscal policy and issue enough bonds for you to do your monetary policy?
Yeah, I mean, I think the easiest say is we can only play the hand that's in front of us at any point in time. The choice of instruments will certainly be a function of the options that are available and the operational capacity to achieve that. To date, and that's going back to Janine's question, that is very much why we emphasise the separation between fiscal policy decisions and our independent role around maintaining monetary conditions. It's also why we continuously talk about additional monetary instruments and the preparedness and operational capability to implement those.
Could you talk through the lending for funding idea, which seems to have cropped up here most specifically for the first time?
I'd like to. It's one of the most intuitively simple ones that have been put in front of us recently, but I'm going to... Christian, do you want to snatch success?
Yeah, so it is very much linked to this concept of having a negative official cash rate and the desire to make sure that as much as possible that this is passed through to lower interest rates for households and businesses, which ultimately matter for the economy. So combining a low official cash rate with a funding and for lending program where banks are able to get funding directly from us at near OCR rates, that gives us an assurance that banks will be in a position to lower their funding costs and then pass that on ultimately to their household and business customers in terms of lower lending rates.
It's an additional funding option for banks at for you a very good price.
You mentioned in the statement.
Sorry.
Use this microphone so everyone can hear you. I'll hold it.
You mentioned in the statement that the 60 billion announced previously dragged down bond yields by at least 50 and maybe 100 basis points. Would you expect the same extra drag down from the extra 40 billion proportionally, or do you think there's diminishing returns?
Yeah, I think it's a very hard thing to estimate because the market has already priced in to some extent was expecting the LSAT program to continue increasing in size. So I don't think it's quite as simple as the additional size having the similar impact that we've had so far. We do think that what we've delivered is larger than what was expected in the market, and we do think that it will result in lower and flatter yield curve.
But at the same time, we do understand there's a limit to the influence of monetary policy alone along explaining the full yield curve of Aotearoa New Zealand. So I'm sure there will be some diminishing returns in there, and hence I reiterate our desire to be actively progressing alternative instruments.
Sure. Cool. Thomas Coughlin from Stuff.
Tom.
If the situation came up where you were to purchase bonds directly from Treasury, would you first seek the approval of the Finance Minister in the way that you currently look for the indemnity when you expand the LSAT program? There's
a nice subtlety challenge in that question. Sorry, Naomi, you may. Are you proposing to him? Is it a leap year? It is. A subtle challenge in that question in the sense that we can directly buy and still not be money financing. So, i.e., the government is determining its own fiscal policy. The fact that government bonds are one way in which they've raised their money to do their spending, we can choose to buy those. We could choose to buy that directly from the government or through the secondary market. That leaves us still operationally independent to choose the quantity or not we wish to buy. So yes, we could go direct there. The step beyond that would be what is often called money financing, and that is where the government would be providing some kind of decision, some instruction, some remit to the central bank to purchase a certain level of government bonds for their spending plan. So it's a very different concept. The first one, as we operate today, is where the government's determining how much they need, and the fact they use bonds is one of their many instruments of choice. Likewise, we determine what conditions we need, and the fact we chose to use some of those bonds is our choice, very independent.
And just on that, former Prime Minister Jim Bolger said this week that he would recommend at a certain point you writing off a lot of this debt for the government. Is that something you'd ever consider?
It's not me to consider such an issue. That's I don't issue the debt, and I don't write the debt off. Those are assets on our balance sheet.
It's Rebecca from Business Desk. I just had a question again about the funding for lending. So if it sort of goes hand in hand with a negative OCR, and you would be lending money to banks around the OCR level, does that effectively mean you'd be lending them money at a negative rate? So paying them really to take money?
That's correct. But a negative OCR also means that banks would be receiving a negative rate on their settlement balances that they hold with us. So those two things would effectively cancel out. Yeah. And just to reiterate, we're talking about negative rates for wholesale institutions. We're not talking about this for retail.
In the event that this all sort of comes to pass, you would expect banks to pass this on as well to retail and business lending, but maybe not into negative territory?
That's right. I mean, in our documents that we fortuitously prepared last year, it was only last year, we talked about the limits to, for example, a negative official cash rate. And some of those limits are around banks. We would only be part of the funding. Banks also have to attract deposits. They have to compete with each other, so on and so forth. So there is some limit to which the retail interest rates will reach where people, individuals, will choose to do other things rather than deposit with that particular bank. And so we don't know what that level is. We know it is below zero for the official cash rate. We don't know how far below zero, and having this funding for lending assists us. It's a combination of efforts that don't put all of the strain on a single instrument.
Governor, another question from Kangan News. Look, you suggested that you'd like to see interest rates go lower. So does the RBNZ have a target in mind for government bond yields, or would a target be considered?
We don't have a target in mind. We're not what would be called yield curve targeting, I think, is that the frame. So we are saying aggregate downward pressure as far as can go to levels. Would a target ever be considered? I wouldn't rule that out, but it's not on the table at present.
Yeah, nothing to add.
Governor, could you talk through how high in the priority list buying overseas assets is in the various tools that you have here?
Yeah, we've delivered, our language, and hopefully, Bernard, you've picked that up. It sits at the bottom of the preferred list. That's not because it's an unsexy thing to do, it's because it is effective under certain conditions, and the conditions we're facing at the moment are not those conditions. So generally you would be wanting to alter the level of the exchange rate when you think it is extremely over or undervalued, when you think that people are holding those risks are largely unaware of that, when you think that a small but perfectly chosen movement from a central bank will alter the risk balance, and you will get a decent bang for your buck on the exchange rate level. That is not the conditions, and largely because this has been a global shock, not a shock specific to any one country or New Zealand.
And potential foreign assets, have you thought at all about what type and off who and how golden or not it might be?
We're not that advanced, but I would be as brave to say they will be pretty bland, because credit risk will always be important for a central bank, as well as liquidity.
Can you tell us a bit more about what you are seeing from, I guess, credit availability from the banks, and particularly for commercial property, both in terms of how much credit is being provided, but also whether you see a particular problem in the loans that banks have to commercial property?
Yeah, that's good. Jung, do you...
Credit growth is still happening, but it's largely through working capital and through restructuring of loans. We know that banks seem to be reluctant about accepting new customers, so that channel seems to be a bit impaired for the time being. In certain sectors, agricultural sectors, credit appetite's diminished, but that's been happening for a while now. And more recently, commercial property is another sector where banks' risk appetite seems to be tightening up. So we are conscious that this is happening. Part of it is a normal behaviour in a downturn, but as we say, banks came into this position well capitalised and profitable, and we don't want an economic crisis to be compounded through a credit crunch.
I'm just wondering how you can be confident that a term lending facility and a lower OCR would encourage banks to lend more if already there's some hesitancy, and there are already quite a few, you've made quite a few provisions to encourage them to lend more. Why would they lend more with these two additional measures?
Yeah, I absolutely agree. We've long said we can't force people to borrow and we can't force people to lend. It's going to have to be between, consenting adults out there in the financial transaction world. What we want to do is make sure that we can facilitate at the lowest possible level of interest rates as we needed those transactions on the way through. But the lending decisions, the borrowing decisions are still going to sit with individuals. What we're also very eager on, and what our Chief Economist Jung Ha just alluded to, is that our banking system is very well capitalised. You know that story well. We went through that a long period, and we're saying it's these times now that you want to be using. You stored the hay. You don't like to store hay because you feel like it's costly. Well, then it's time to feed out and make sure that you are part of the ongoing maintenance of the economy and a critically important part about any economic recovery as it comes about, because that is where monetary policy will be highly effective. So that's it. It's also why we also talk about fiscal policy being the most direct and, the front stage, because fiscal policy can reach directly in. It can do its own spending. It can do its own transfer. It can do its own investments, the government directly. It's not about creating the environment for individuals to think, wow, the investment incentives to invest now are so encouraging, I will get on and do it.
Yep. I'd also add low interest rates do actually have a positive impact on those with current debt servicing obligations. So while it might not encourage new borrowing to the extent that might be do in the past, it certainly has a positive cash flow impact for those with current existing debt servicing obligations. So.
Jung and the economics team did just a simple rule of thumb. We have to remind ourselves what the New Zealand balance sheet looks like. I think 50% of household wealth is equity in a home. 40% some type of financial instruments, investments, in large part encouraged by the KiwiSaver over recent years, and only 10% are deposits. And so a lower official cash rate, 25 basis points rule of thumb, means about another 220 mil cash flow positive floating around in the economy, to give you a sense of scale. Yeah.
Governor, question from Stephen Wright from Wall Street Journal. Would your monetary policy task be assisted by the government's relying less on brute force lockdown measures and doing more to facilitate business and industries to operate safely?
We don't comment on government policy. We play the cards that are dealt in front of us.
Where are things at in terms of extending or possibly extending mortgage repayment deferrals?
Yeah, so a great question, thank you. And we have agreed to extend. We have not finalised those details with the banking sector. We hope to have those finalised early next week, sometime next week. But here I go. I want to encourage people not to suddenly grab their telephones and start ringing their banks, because their banks do not have the details, and the banks do not have the current capacity or capability to be dealing with that issue at the moment. In particular, as they're heading back to level 3 and all of the BCP challenges the banks have involved. Also reminding people that the current mortgage deferrals are as they are until end September, and very soon you'll hear about what an extension is. As always, an extension is not permanent, but you know, the banks and the customers will have more time to be able to work through what needs to be done.
You mentioned that the credit extended to the business sector has mostly been restructuring and working capital and the likes, and that the lower interest rates from the previous easings have been passed on in mortgages. But looking through the statement, you report about tightening lending standards for business, and also that you're doing some extra work on finding what the actual new lending rates are for businesses. Has the loosening of monetary policy only really helped the household sector and not the business sector?
No, it's helped across the country. So again, I'm probably repeating, I think it was either Christian or Jung. You know, when you think about a lower interest rate, first and foremost, anyone holding a debt now has an improved cash flow position. And that goes across households, businesses, the lot. The second part is, of course, it means a lower exchange rate than otherwise. The interest rate differential case, well, you know, the New Zealand dollar has gone up. I can't tell you what the counter would have been in the absence, but, you know, it provides that lower than otherwise. The third one around is through wealth and the asset price channel. You know, we hear from depositors saying, I'm not feeling happy about this. Likewise, though, those who own assets around the asset valuation framework are up there. So there's a lot of very important channels that this can work through. The second bit then, going back to your question, there's those who have current debt, and then there are those who are looking to either roll their debt or expand their debt. And those credit conditions we look at is for new lending, particularly in the business sector. Credit, you know, standards have risen, so banks are showing a degree of caution. Not surprised, but you know, we need to be aware of that. And for some sectors more than others. And one was, you know, the traditional rural sector we've spoken about here for a couple of years now, commercial property, which was, you know, has been a very hot running sector. And so banks are being more, I suppose, careful or cautious or conservative on their lending on those sides. But otherwise, you know, the lending stats as a whole continue to roll broadly as post. Once we were in that level one broadly as we saw this time last year, in aggregate.
We don't have comprehensive data on business lending rates in the same way we do on household rates, but the data we have got does show some reduction in overdraft rates, and so you know, there is definitely an easing, a softening of those lending rates. We've also seen some improvements or some easing of covenant restrictions. So yeah, it's not all one-sided. There's some mixed signals, I suppose, in terms of what they're doing with the business sector. Some loosening and some tightening, as the Governor has explained across the sector. But yeah, the encouragement is that we need to see them continue to be willing to and open to lending to that sector, and that's really important, particularly as we seek to grow out of this situation.
And it's going to be a combination, I suppose, of refreshed loans for current businesses and new loans for new businesses as resources are reallocated into whatever the new normal starts to evolve, you know, from here on out, and that credit flow is critical.
So we're not near the level that some other central banks have got to, where they've had to lend directly to companies buying their bonds, because the banking system isn't really working so well.
No, we're not, and I'm not sure what or when that would look like, and what sector that would be. So those were quite, during the GFC, there were quite specific issues in specific sectors where that was prompted, the TARP programs. Yeah. Wonderful. So thank you very, very much for making it here today. Kia kaha, stay well, stay safe, follow our instructions. Thank you very much.